Danny, Logan, welcome to this New York market talk about the west side of Manhattan.
Thanks for having us.
Yeah,
Thank you for having us.
yeah, good to see you guys. So, the neighborhoods along the west side of Manhattan have some of the most popular residential neighborhoods in the entire city. And I think the dynamics that are occurring in many of these neighborhoods are different than others for that reason, and how they're responding and what they're dealing with in terms of obstacles and also opportunities in the time of coronavirus. So I wanted to chat with you guys about that. And one of the things we were just talking about before we started recording was the whole idea of flight to quality. And I think you have that in two categories. One is from the renter's perspective and also from the investor's perspective. So let's talk about that, because both those dynamics are occurring on the west side of Manhattan right now. And, how are you seeing that from the investor's standpoint, Danny? And then we'll talk about it from the renter side in a second, Logan.
Sure. From the investor standpoint, if you take the realm of New York City, the market of New York City, which is all five boroughs, investors are saying, I want to be out of the kind of tertiary, secondary markets, and I want to be below 96th Street in Manhattan. And then you drill down a little bit further and they say, I want to be in the best parts below 96th Street in Manhattan, which usually means the lower west side. So West Village, Chelsea, but even Midtown West and the Upper West Side. Mm-hmm. And they're seeing that, and this will segue into what you spoke about with the tenants. There's a lot of talk about tenants leaving the city as the city's closed down. People are waiting for it to reopen to move back into the city. That is happening, and vacancies have gone up. But many tenants aren't necessarily leaving the city. They're just upgrading locations within the city.
Right.
I spoke to a landlord, for example, on the Upper East Side, who had a tenant who'd been in place for 4 years, who said, it was my dream to live in the West Village. And now I can afford to live there because the rents have come down.
Yeah.
So they're staying in Manhattan, but they moved to the West Village for a similar apartment.
Yeah, I think that's an interesting dynamic to point out, because everyone's talking about vacancy and collections and all that kind of stuff with the rental market. The rental market is definitely in flux. But if you're an opportunistic renter right now, this is the time to upgrade. At least from a location and probably from a quality of unit standpoint, this is the time to do it. Logan, are you seeing that as well from the investor standpoint? I know we're marketing several things along the whole west side right now, and you've received very comments that have been very informative from the type of people who are coming out to tour and having conversations with and making bids on buildings on the west side in terms of what they're saying about why they are looking at those assets now. And some of them haven't looked at buildings to purchase on the west side for many years. So give us a little insight into what the buyers are saying about why they're looking at buildings on the west side now.
Yeah, absolutely. So I think that most of the buyers that we're dealing with day to day, they are, like what Danny said, are looking for flight to quality. I mean, when the market is typically struggling and prices have come down a little bit and you can acquire buildings at lower bases, that is the time where you can upgrade your location significantly. And I would say that out of 70% of our tours in West Chelsea, the Village, Midtown West, the investor is there because of the location. Mm-hmm. If they can't make it work on paper, they feel like it's a little too expensive for them, they will still come tour the building because they know the location, and if they can fall in love with the asset, they're going to try to make it work.
So there was just a recent portfolio that traded that maybe I don't think it's totally hit the public yet, but we'll talk about it a little bit from a cap rate perspective. I want you to talk about this because when this hits the transom, it will go through well north of a 5 cap, and those are real opportunities, and those type of cap rates we haven't seen on the west side in, I don't know, I can't.
Definitely not
that type of stuff. So go ahead, talk about that.
No, and for the last, I've been working in Chelsea now for 7 years, and most of the buildings that we would market and sell, if there was a value add component to them, those were trading at 3.5 to 4 caps. 4.25 caps, and investors are trying to stabilize those close to that 5.25 or 5.5 number. When now we're seeing, that portfolio that you just mentioned, it traded for close to $25 million. predominantly free market, 64 apartments. That's going to be done in the mid-5 cap range going in. So this buyer is going to be, probably stabilizing this thing over a 6% return, which was not common to see on the west side.
Mm-hmm. The other buyer category that I think makes an impact on that whole side of Manhattan on deals is the user category. And Danny, why don't you speak to this? Because anytime you're selling a building in New York, I mean, particularly on the smaller side, but anytime you're selling any asset, I know, we sold a building over $100 million within the past year that was purchased by, a group that was ultimately going to use it. So talk about how that impacts the sales market and how you're seeing that come through a little bit now. I know there was a trade a couple months ago on the Upper West Side that occurred to a user. And I don't know, why don't you just speak about that dynamic, because that's something unique to this market.
Sure. Well, one thing, a comment I used to get when we would be marketing walk-up buildings, whether it's Upper West Side, Upper East Side, really anywhere below 96th Street. Buyers would say, how can I possibly get these rents? How can I justify or presume I can get these high rents when there's an elevator building with a bunch of amenities and a doorman around the corner, and they're asking rents aren't that much more, and maybe they're offering a bunch of concessions? Why would anybody choose to live in a walk-up when I can go live in a luxury elevator building around the corner?
Right.
And now we're seeing that people are a little bit more reluctant to move into these larger buildings because they have to share an elevator and there's 30 or 40 floors. So whether it's a user, and for the user standpoint, maybe you're talking about, Peter, a 2-unit or a 3-unit, 2-unit family or 2-family or 3-family, where you have 2 or 3 separate families living in one building. But
right.
even if it's maybe 6 units or 8 units or 10 units, and you can have the building set up in a way where it's essentially, you don't have to come into contact with any other tenants in the building. It's a little bit quieter. It's a little bit safer feeling. That's been a big draw for tenants. So these walk-up buildings that people thought couldn't compete, some landlords thought, how do I compete with these larger luxury elevator buildings? Now are becoming a lot more attractive.
Yeah, it's a dynamic in the market that that is unique to that. Let's talk about collections. This obviously, I think, well, you have 2 parts of the income side that all owners are focused on right now, which is collections and vacancy. Collections, by and large, below 96th Street have been pretty healthy. There are other parts of the city that's much more where that aspect is much more of a concern. But the other is renter demand. And I think south of 96th Street in Manhattan, some of the better neighborhoods of Brooklyn, this is the primary thing to be focusing on if you're a owner right now. And Logan, why don't you talk about that? Because you've got some real on the ground data about what owners are reporting about their occupancy levels, and then how they're adjusting to it. So what are you seeing, and what are owners doing about it?
Yeah. So, after speaking with a lot of the active guys that we're dealing with day to day, it seems like vacancies have been close to that 10% number across the board for the village, but there are a handful of owners who are operating significantly above that.
Mm-hmm. Where their vacancy levels are significantly above 10%, right?
Yes.
Yeah.
About significantly above 10%.
Now, I think this is where this subject intercepts the lending market, because there will be a tendency for owners to keep their asking rents high, depending on what type of leverage you have on the building, what your business plan was. There's going to be a reluctance to drop your rents. So it's just a very confusing time. And then you have a scenario, especially in some of the better locations, where ultimately there will be a backfill of renters who may be exiting other parts of the city and renting in these locations. So, is your general sense that owners should hold firm now and kind of wait as we go into the fall and late fall and hold those units, or should they try to move them and drop their rents as much as they can?
I think that, it might be early to say, but I think that owners should meet their tenants and try to rent those units, because I understand that it's connected to the financing and it might affect the underlying mortgage or the rate they might get or the proceeds. But buyers, when they're looking at these assets, and I'm talking, from a transactional standpoint,
Right.
they want to see stable income right now. When you're projecting rents and vacancies, buyers are discounting that right off the bat. They know what's happening in the market. They know about the concessions being given. I mean, in Chelsea, people are giving 2-3 months concessions to try to keep that gross rent high.
Mm-hmm.
And like Danny was speaking about earlier, that's why these people are flocking to these neighborhoods right now.
Right.
And renters from the Upper East, you could get your one bedroom there for $2,800. That used to be $3,500 in Chelsea. With your 3-month concession, you're in that $2,000 range now.
Right. Yeah. Danny, did you have something to say to that?
Yeah, I had something to say. So something I've noticed that's really become a trend just over the last, let's say, 30 to 60 days. 2 things every buyer is asking for now. They want to see a collections report for the building,
Mm-hmm.
and they want to see example of 2 to 3 leases, depending on how many units in the building, that have been signed over the last 30 to 45 days.
Mm-hmm.
So it's no longer just let me see the current leases to verify the rent roll.
Yeah.
I want to know what's been signed over the last 30 to 45 days to see where those rents are. I want to see what concessions you've offered. So, and banks also are asking for a collections report as well.
Yeah. And you want to see the current leases because you want to see what other goodies may have been in those leases that just don't show up on a rent roll. So I think that's a comment just generally about the whole market. Every market participant, buyer, lender, sellers need to be aware of this, is that from a documentation standpoint, just because where we are in the market, there's a much higher degree of diligence and request for everything needs to be, seen and checked twice right now. And that's part of what's slowing up transactions, but it's also just everyone is double checking everything. So that's great. These have been good comments. I want to end on one subject, which is kind of the crux to the transactional market. And for anyone who's a seller or a buyer, they want information on this, which is the delta between the bid and the ask. And, we're seeing this start to come together in some of the markets, some of the tertiary markets first, actually, that this is the spread between the bid and the ask is coming closer. Talk about this on the west side. I'd like to hear both of your opinions. Danny, why don't we start with you?
Sure. Well, it's interesting when you're talking about buildings on the west side, talking to buyers, whether they're new buyers to the market or buyers who've been active on the west side over the last several years. Pre-rent law, there was a lot of talk about, about what's the upside, and we're kind of pricing that in. So it was there were a lot of basis buyers saying, if I can buy this at the right per foot, I can make sense of it. As we know, the rent laws passed and it became more of a going in cash flow. What's the yield today?
Right.
But interestingly enough, I had a conversation with a buyer yesterday who owns about 300 units on the west side of Manhattan. And he said, I'm no longer looking at this as a cap rate play. I want predominantly free market, but I don't even know how to underwrite a cap rate today because I don't know where my rents or vacancies are going to go over the next 6 months. So now I'm back to Danny on a basis play. I need to make sure that I can buy this at the right per foot and figure if I can get it at a price that makes sense and my basis is low enough, then I'm not so worried about what's going to happen over the next 6, 12, 24 months with the rents and vacancies and these issues we've been talking about today.
Yeah, that's interesting that you bring that up. Two things that came to mind with that. One is that everybody is using time so differently right now. So to this buyer, they're thinking through a 7 to 10 year time frame. So how they act and how they respond to everything that's happening in the market, they do it one way. If you have a 6 month to 2 to 3 year time, viewpoint, you're going to react to everything that's happening right now completely differently. So, it's really interesting that you say that. And the other is, and we saw this a lot from all the participants in the market, and by that I mean banks and appraisers and everything, is that if you couldn't agree on an NOI, how can you do anything? You generally don't have 100% exact consensus on what the building's net operating income is, but generally, whether it's a buyer, seller, lender, whoever, you guys are all within the same range. You can agree, generally right now, either people don't know or nobody agrees because the opinions are so wide. And that until you have agreement on what today's NOI is and what it will probably be tomorrow, that really clogs up the gears in terms of people being able to make do transactions and make things happen. So Logan, what are your final 2 cents on the bid and ask as far as the subject matter?
So, obviously owners got pretty slammed by the rent laws previously. And we saw in a lot of cases buildings drop by 20 to 40%. And that delta got a little bit bigger then. And it took a little bit for owners to kind of swallow, the regulation that just happened. And then this time around with COVID, you would think that the delta would increase, right? Because buildings potentially took another hit, but it actually seems like the delta was shrinking in my eyes a little bit right now because owners, they think it's going to get worse. I think a lot of them and a lot of sellers in general are coming to terms that, I would rather get out now before the uncertainty, because we're in an uncertain time. And I think that provides a lot of inherent risk to anyone looking at these assets, which is why you are starting to see a lot of these buyers and sellers connecting, when it's off market, people you didn't think that would sell before, or just on the market. We're seeing activity really pick up in the last 30 to 60 days.
Yeah, well, if anything, all these events, they've really kind of accelerated people's decisions.
Exactly. And I think I'll end on this. I think that in a transactional sense, I do think that there is a perfect storm kind of brewing right now for transactions to occur. You've had so much downward regulatory and financial pressure on owners. While at the same time, you've had so many larger funds, syndicators, buyers sitting on the sidelines for the first 6 months of this year. And they need to deploy their capital to keep the wheels spinning in their company, their employees active. And so now you're starting to see this connection happening where people will be forced to sell and people will be forced to buy.
Yeah. Yeah. Well, that's great. I appreciate both your guys' comments, Danny, Logan, and we will add some links to some of the sales that we talked about here, some of the things we're offering, and then also our sales report for the entire West Side will be added in the links to these notes. And thanks a lot, guys.